Hello there folks, and welcome into this video here today. So we got two videos to react to. It's a 2-for-1 day here. First one up here, we're going to react to this one about Netflix stock getting upgraded, and I want to kind of give my perspective on Netflix stock, okay? And then this video we're going to get into, which I think is very, very interesting, okay? And the reason this video is so interesting is there's a specific stock that is essentially mentioned in this video, which is not a stock that I've ever even looked into, and I got to say this stock is pretty darn, let's just call it interesting, okay? And I mean, I looked at their numbers and I was actually extremely impressed. And I would guarantee you probably 99.3% of the people watching this video right now, you've never heard of this stock that is discussed in this video here today. So I hope you guys enjoy this. As always, thank you so much for joining me on the reaction channel, which, by the way, we just hit 10,000 subscribers in the last 24 hours. So I appreciate each and every one of you for being here. Thanks for being subscribed to the channel. That's absolutely amazing. Like, you know, to hit those sorts of numbers on this reaction channel this quickly is, you know, just I would call it a blessing. So thank you very much for everybody that's subscribed to the channel. I'm glad you guys are enjoying the channel where we react to different content. So let's go ahead, let's jump into this Netflix one, and from there we'll get into the even more interesting one. No, by the way, just to mention, before we get into Netflix, I do own a small amount of Netflix shares. I bought them at $181, probably a couple months ago now. Very small position, less than $10,000. I'm a little undecided on what I'm going to do with Netflix stock since I have less than $10,000 invested into it. I'm like, do I want to buy more shares? Do I want to sell my shares? I'm trying to figure out all that. Obviously, there's a lot of stocks that are down massively this year, and that I just, you know, 20 or 30 or 50 or 100 different stocks I feel like are great buys right now. So it's like, do I want to put more money in Netflix or something else? Okay. So yeah, I'd love to hear your guys' opinion on anything we discuss in these videos here today.
Media analyst Tim Nolan, who just upgraded Netflix to neutral from underperformed him, have a $230 price target on the stock, which is basically where we are right now. So it's not.
I hate that when somebody, you know, upgrades the stock, but they have a price target that literally is the same that basically the stock is trading at today. It's like, come on, man, come on.
Exactly a bullish call. What's your feeling on Netflix?
Right. Well, we were bearish on Netflix because we just saw these streaming wars taking off and so much competition from Disney Plus and so many other players, and just you know, pressure on consumers' time to spend with streaming and the amount they're willing to spend on all these different services. When Netflix came out with the discussion of launching an ad-supported tier, that began.
Okay, before we get into the rest of this, it's important, and Netflix executives have said this before, okay? Netflix executives have given the hidden secret on who their real competitors are, okay? They did this, it might even have been a year ago now, okay? And what they said, you know, their competitors obviously can be anybody that's streaming, but they looked at their main competitors as even like social media. So think of things like TikTok. Think about things like Instagram. Think about Facebook. Think about, I don't know, Twitter maybe. I don't know about that one, okay? Snapchat maybe, I don't know about that one. But in terms, if YouTube, okay? These are massive competitive threats for Netflix because Netflix wants people to spend, obviously, you know, quite a bit of time on there watching 30 minutes, an hour, several hours of programming on Netflix, right? And it makes people like the product more, potentially, unless they get sick of all the content, they've gone through it all, right? So when there's less time to spend, even video games or anything that takes attention away is a competitive threat to something like a Netflix, right? And the same could be said for everything else out there in the universe as well, right? There's a finite amount of attention. So all these things are competing against each other all the time. Twitch and YouTube and Netflix and TikTok and you know, all the different social medias and all those things. There's a finite amount of time to go around. So that's just something important to keep in mind in regards to the Netflix story, that even the executives have talked about this before.
Pique our interest again. And so what we've done today is produced a report that really digs into how the math works behind this. And
ads could generate $2 billion in additional revenue. Okay. You know, Netflix is a company that should do a little over $30 billion this year. They should do, I think, $31 or $32 billion of revenue this year, okay? So $2 billion is definitely a nice increase, but that's less than 10% of their total revenue, so do keep that in mind. You know, maybe that number's low. I don't know. That's just what he has up there.
We estimate that it could be not only a strong ad revenue business for Netflix if they roll it out smoothly, but in terms of incremental revenue to the company and earnings, of course, factoring in, you'll have some migration of paid subs to this lower price tier, still leads to some good incremental revenue and earnings performance for Netflix over a few years' time.
So do you see that as already being priced into the stock at $228? It's still down almost 70% year to date.
Year to date, yeah, it's up from its lows quite a bit. We just felt that it's past the worst. Now, who knows what the next sub number might be when they report Q3? That's always the primary driver of the stock. But the fundamental view that we're taking here is that ad-supported streaming is growing over ad-free, more expensive streaming because consumers can afford to pay for more of those services.
That's a nice bottoming process there in the stock. Yeah, that's a very nice bottoming formation. We call that there. Holy smokes, man. 5 months of just, trying to figure it out. We call that trying to figure it out.
So the CPMs, the dollars, per impression that the companies receive on the ads that they place can be actually very high. And so the ad-supported streaming services can be actually more lucrative than the ad-free services. Netflix has woken up to this. They may be launching the service already on November 1st, is what we're reading most recently. And that, we think, can actually lead to some nice incremental revenue growth, again, over the next few years.
Sure.
Now, it's still a very crowded marketplace, right? And we didn't go to an outperform, we went to a neutral. It's also a difficult ad market we're going into. If we have an ad slowdown, which appears to be underway as the economy slows, it's not exactly the best market to be entering into.
So he brings out a great point there. It is a weaker ad market. They're starting their service in, no doubt about that. Also, to keep this in mind as well, Netflix basically kind of got leaked that Netflix is looking for a premium versus what other people would pay other places for those same impressions, okay? Now, my opinion on this, despite it being a tough ad market and despite Netflix wanting a premium, I still think they're going to attract a crazy amount of big advertisers from basically about day one, and especially this first year and obviously in future years as well. And the reason being is it's Netflix. And the way a lot of folks are going to look at this is, they're going to feel like no one's seen ads on Netflix, right? At least not traditional ads. They might have seen ads other ways, like little product promo in different things and things like that. But no one's ever seen direct ads in Netflix. So when that actually launches, right, it's going to seem special. And I think, if anything, they're going to get, let's just call it, people are going to see those ads more often and actually look at them and watch them and things like that. And I think that's the way an advertiser would think versus a saturated market like people are so used to tuning out of. Like, let's say you watched a live event on traditional TV. Let's say it's a sporting event, for instance, right? If somebody watches that, like we've become so accustomed to, it's going to commercial break, what do? Usually you get your smartphone, or maybe you go to the fridge and get a drink or go to the bathroom or whatever. But a lot of people just got programmed like, it's commercial, I'm on my phone, So yeah, that's just something to kind of keep in mind. I think Netflix will still attract massive companies to advertise despite it being a weak ad market and despite them wanting a premium versus everybody else, because at the end of the day, it's flipping flapjack and Netflix.
Netflix has great brand recognition, great user base, good data to target ads to those consumers.
That's true.
And it's a structural shift from linear traditional TV into more connected over-the-top streaming TV advertising.
What I liked about your note also, Tim, is that you mentioned a few other stock winners that could be part of the whole ecosystem here with the Netflix ad tier pricing. The Trade Desk, I think, was mentioned, and Roku. Mm-hmm. Do you like those names? I don't know if you cover those stocks, but what's the benefit for some of those companies?
I do cover them, and I do have buy ratings of both of those two stocks as well. There's a lot of hubbub over the news that Microsoft is going to be the exclusive tech partner to Netflix when it rolled out its ad tier. I'm not fully on board with the view that Microsoft will be exclusive. I think there are opportunities for companies like the Trade Desk to be buying those ads on Netflix. And I think there's an opportunity for Roku as well to be trying to monetize some of the revenue that Netflix will be generating on the app, on the Roku platform when it launches its streaming service. So I think there are opportunities for their ad tech players. I think this is a good opportunity for the connected TV ad ecosystem as a whole. Again, Netflix is the single largest subscription service in all of streaming TV, and they are opening their inventory now to advertising for the first time.
Yep.
Yeah, I think also interesting point you make about Netflix shows may be available on the Roku channel.
I love that there. A good piece on kind of Netflix. I hate it when people upgrade a stock and keep it at the same price target, but good information nonetheless. As far as my play on that space, the main play I have is a company named Fubo, which is much higher risk reward than a Netflix. Money loser, big money loser, and likely will be for the next probably 2 years. But that one has, you can't even compare the upside in something like a Fubo versus a Netflix. Like, Fubo, as long as they make it through and keep growing customers, that's like a 10x easy. They just have to make it through this next 2 years. And that's a process you have to go through that involves a lot of volatility. Netflix is a proven business model, very solid. They're going to put up solid subscriber numbers, keep putting up solid revenue growth numbers, but it's not the growth story it once was. Netflix this year is expected to grow revenue less than 10%. Next year, revenues expected to grow less than 10% from Netflix. So Netflix is it's morphed into a value stock at this point. It is no longer a growth company. It's a value company, which value companies are those slower growth companies, right? But it's no longer that company that was once growing revenues at 20-30% type clips and adding, many millions of new subscribers quarter in and quarter out. It's just not that sort of company anymore. So it's I think a lot of the value investors have started take a look at this one and potentially invest in it, okay? All right, guys, let's get into this next video in which a stock is mentioned here that I think is a very interesting stock that I've never heard of and most people haven't.
Specifically, though, because that's where I think a lot of people's focus is right now, given the losing streak that we had, the little bit of a bounce today, if it means anything of a reversal for this space.
Look, I think thank you so much for having me, by the way, as always. I think one of the issues that we face is we're stock pickers. We're talking to companies on a daily basis. And what we're hearing is one company after another where fundamentals are deteriorating. I mean, if you take the software sector as an example, we're seeing slowing decision cycles and slowing IT spend. And that's particularly the case for companies with large European businesses. I mean, just in the last week, you've had MongoDB, Okta, AI, Palantir, UiPath, all either missing, guiding down, or both. And so, the forward prospects for growth in a number of these sectors are not good. The same is true in a lot of pockets of semiconductors. A lot of these companies have taken very significant pricing because of all the shortages that have taken place, given the impacts of the pandemic, and are at peak margins with inventories also very high and the demand picture starting to look south. So despite the fact that prices have come down and the market's obviously pulled back substantially, I think the issue is the ability to rally around companies where the fundamentals have bottomed because it seems like numbers in general in tech are headed more downward than they are upward.
Okay, so
obviously in a slowing cycle here, right? I think everybody knows that if you look at quarterly numbers of companies. But with that being said, then we kind of get into an argument of how long does this last, right? How long are we in a slowing cycle? How long does it take companies to make longer decisions if they're going to get a new software like a Palantir or from another company and things like that, right? And then we have to get into an argument of, do these stocks deserve to be down 50, 60, 70, 80% like many of them are, right? And that kind of gets into, well, where are these companies actually going over the long term versus a short term, slower time period for all companies, right? And that kind of goes into what we are likely in right now, a recession, right? Which is obviously we had 2 quarters of negative GDP. We've seen from even the biggest of the big companies report very slow growth. I'm talking the Apples and the Metas and you can run through it. They run through the whole list of those stocks. Very, very slow growth for those companies, even Amazon, Google, all those companies. And so we're in that sort of time period, but it's not going to last like that forever, right? Maybe you have another 6 months, 12 months, 18 months, if it's really severe, of that sort of cycle going on, right? And then you get out of it and the world resumes on and growth happens again, right? And so, I think it's good to kind of figure out the short term versus the long term. And the problem is a lot of the time these folks that definitely can go on to different networks and things like that, they're very focused on the short term. And this guy, he might be thinking about where tech stocks are headed over the next 3 months, 6 months, right? Which once again, that could still be a 50-50 if that's going up or down as far as all that goes from kind of that perspective.
given that's your view, and I think it sets up what I wanted to do during our conversation today, I want you to listen to what Glenn Kacher told me a couple of weeks ago. He's a noted tech investor from out on the West Coast from Light Street, owns a lot of the enterprise software names that were in the crosshairs. A lot of them have come down, as you said, quite a bit. But here's what he told me, and I want your reaction to it on the other side.
This seems like a incredible buying opportunity for our industry, and so we're incredibly positive, and we like the portfolio that we have built to come out of the current environment that we're in right now. We're kind of bouncing along a bottom here, and expect that.
I'm probably one of the last people you're ever going to see in a suit. But with that being said, and I mean no disrespect, I don't know about this suit choice, okay? For some of my men out there that you guys wear a lot of suits, what do you think about this choice here? I'm not so sure about this. Holy smokes.
When investors decide to come back and take more positions in this sector, that we're in the right stocks that are going to benefit greatest from that re-rating.
So he brought out a great point there, and I agree. Eventually people are going to come flying back to the software as a service business models, and those stocks will have a very fun time in the market. Let's just put it that way. Those are always seen as the holy grail of the stock market, any of those sorts of companies. And in this sort of cycle we're in right now of 2022, people don't want anything to do with those stocks, right? But most of the time, you are not in these sorts of cycles. So, when it comes to growth stock, people will funnel back there. And when it comes to those SaaS-type business models, they're seen as a holy grail. That's why they always trade at a premium versus basically any other stock in the stock market. And money will come flooding back there.
Why doesn't that make sense?
So I think one of the issues has to do with valuation. The other has to do with numbers. If you look at multiples that software stocks have traded at in terms of EV to revenue, you saw in 2017 stocks in the highest growth bucket, so the company's growing in excess of 30%, trading at, call it 6 to 7 times revenue. That peaked last October, November, up at 40 times revenue. And we're back down a lot, right? So we're down, call it 10 to 12 times revenue. But, who's to say that we're not going back to 2017? There are macroeconomic forces at play here that are impacting demand. I mean, you guys have talked a lot about that, so I won't get into it. But as demand goes down, companies are going to be missing numbers, and it's very difficult for multiples to be expanding in an environment where companies are missing numbers. All of that being said... Okay, real quick here. Companies missing numbers, they have been missing numbers, but to just say they're going to keep missing numbers, I think is a big stretch there, big stretch. They might, could be possible all of a sudden in a couple quarters from now, companies start beating revenue and maybe we start getting on the other side. Who knows? Maybe this upcoming quarter, no one's expecting anything from this quarter from companies, anything good. What happens if all of a sudden this quarter, a bunch of companies beat revenue, beat EPS, and shock the world? Like, we don't know, right? Because no one's expecting that. No one. Think about that for a moment, right? So I just think this kind of shows like how far folks have gone with just this negativity cycle and just assuming like companies are going to continue to miss numbers. And it's like, says who? Says who? We do have a number of investments in the software sector that we're very excited about. We currently have a significant position in Five9, which I believe we talked about on your show. We also have a sizable position that we've been building recently in a company called Bill.com, which is one of the leaders in the payments space, and it's an accounting software, bill pay, invoicing. There's a huge pocket of credit card companies out there that are servicing small and medium-sized businesses, and what these guys are doing is they're coming in, they're replacing the credit card, and they're augmenting that with bill pay and with invoicing and centralizing accounting for small businesses, and they're taking share like crazy. I mean, they've got 150,000 customers right now. They're growing their transaction value over 50%, their revenue over 100%, and we like that one a lot. It's down significantly year to date and from its pre-pandemic peak.
So interesting stock there, I gotta say. And I posted this in the stock chat in the private stock group, which, by the way, if you're ever looking to join my private Discord chat, check out the pinned comment down there to apply to join us in there. But I posted kind of the expected numbers here for this company, and it's actually pretty darn interesting. So one is they're on a interesting. They're in an interesting time period for their business model. They're in the interesting time period where you go from an unprofitable company to a profitable company. Now, usually when that happens, you see a massive, epic move up in the stock price. Now, 2022 is a kind of a freakish year, so it's a different type of year. Let's just put it that way. But in most years, when a company flips from this unprofitable stage to a profitable stage, many times that stock price can just absolutely fly, right? So they're going through that time period right now, expected to be profitable next year as well. By the way, these are fiscal years. Just if you're confused why it says 2023 there, it's their fiscal year, which means it's their fiscal year, okay? Not the calendar year. That's going on. And expected to have EPS, obviously soar the following year. 50% revenue growth expected in current year, and they're expected to get close to that $1 billion number there. And then next year expected to have revenue go up 33%. Now that is quite a big deceleration if that was to play out like that, and we'll see what happens there. But yeah, I got to say that sounds like a pretty darn interesting stock, and I'm gonna have to do more digging on this one. It's not one I was aware of before that gentleman brought it up, and that's why I always I love to just stay in the different communities. I see different videos, I see different articles. I'm always in, obviously, the private group in our Discord chat and see like the stocks people talk about in there, because sometimes, folks can bring an interesting stock to your attention, right? And if anybody's brought any stock to your attention probably in the past year, it's probably down massively because that's where all stocks have gone, right? But, there's going to be a lot of those stocks that become massive winners over the coming years. And who knows, maybe a Bill.com is one of those type of companies that becomes a massive winner and becomes, 50, 100, type $100 billion type market cap over time. I'm gonna have to do more digging on that one, but it is an interesting one. So anyways, I hope you guys enjoyed today's video. Much love as always. I appreciate you joining me. Over 10,000 subscribers now. You gotta be flipping my flapjacks. That's absolutely insane. And thank you for everybody that is here and enjoying the channel. Check out the big channel as well when you get a chance. Much love as always, and have a great day.